Imagine this. You just finished a long, exhausting month at work. Maybe you were standing behind a counter all day, dealing with customers, running on coffee and little sleep. Finally, payday arrives. You check your salary notification. It says you earned $2,000 this month. But when you open your bank account, only $1,450 actually shows up. Where did the rest go? You look closer at the payslip and suddenly see a list of deductions: income tax, state tax, social security, healthcare contributions. Welcome to the modern financial world. Taxes are essentially the price we pay to live in an organized society. Governments collect money from citizens to fund things that individuals cannot easily build alone: roads, hospitals, public schools, emergency services, and national defense. There are many different types of taxes. Income tax is taken directly from the money you earn. Sales tax is added when you buy something. Capital gains tax applies when investments increase in value and you sell them for profit. Then there are taxes like Social Security, which function like a forced retirement savings program. You contribute during your working years, and later in life you receive payments back. Another deduction often funds public healthcare programs for elderly citizens and people with serious medical conditions. Eventually, everyone must deal with something called tax filing. This is the yearly process where individuals report income and calculate whether they paid too much or too little tax during the year. If you paid extra, you get a refund. If you paid less than required, you must send the remaining amount to the government. Taxes may feel frustrating, but many countries with strong public services rely on them to maintain infrastructure and stability. Now let's talk about banks. When most people deposit money in a bank, they imagine their cash sitting safely in a vault somewhere, maybe guarded by security cameras and thick steel doors. But that is not exactly how it works. Banks don't simply store money, they use it. When you deposit money, the bank keeps a portion available but lends most of it to other people who need loans. Someone might borrow money to buy a house, start a business, or purchase a car. This system is known as fractional reserve banking. Banks only keep a fraction of deposits available at any given time because normally not everyone withdraws their money at once. The bank earns profit by charging borrowers higher interest rates than what they pay depositors. So if your savings account earns 2% interest, the bank might lend that same money at 6% or 7%. The difference is part of how banks make money. In many countries, deposits are also insured up to a certain limit. This means if a bank fails, the government guarantees that people will still recover their money up to a specific amount. Next comes an idea that quietly controls much of the financial system: interest. Interest is simply the cost of borrowing money. If you borrow $1,000 and repay $1,200 later, the extra $200 is the price you paid for using someone else's money. There are two main forms. Simple interest is calculated only on the original amount borrowed. Compound interest, however, is far more powerful. In compound systems, interest is added to the original balance, and future interest is calculated on the new larger amount. In other words, money begins earning money. This effect works in both directions. If you carry high interest debt on credit cards, the balance can grow surprisingly fast. But when you invest, compound interest can slowly turn small amounts of money into much larger sums over time. That is why long-term investors often emphasize patience. Growth accelerates the longer money stays invested. Now consider inflation. Imagine your favorite snack used to cost $2. A few years later it costs $3. The product didn't necessarily change, but the price did. Inflation is the gradual decrease in the purchasing power of money. Your dollar still exists, but it buys fewer goods and services than before. Inflation can happen for several reasons. Sometimes demand rises faster than supply. If many people want the same product but only a limited number exists, sellers raise prices. Other times the cost of producing goods increases. Maybe raw materials, transportation, or wages become more expensive. Central banks attempt to manage inflation by adjusting interest rates. Higher rates make borrowing more expensive, which can reduce spending and slow down price increases. Now let's talk about something many people fear: recessions. A recession occurs when economic activity declines for an extended period, typically measured by falling production, reduced spending, and rising unemployment. During strong economic periods, businesses expand, people spend more money, and jobs are plentiful. But economies move in cycles. Sometimes growth slows down. Companies reduce hiring, investments shrink, and consumers become cautious about spending. Although recessions can be difficult, they are often temporary phases within longer economic cycles. Eventually businesses adapt, new industries grow, and economic activity begins to expand again. Another financial concept that influences everyday life is the credit score. A credit score is a number that reflects how reliably someone has repaid borrowed money in the past. Lenders use this number to estimate risk. If someone consistently pays bills on time, keeps debt levels manageable, and maintains long-standing accounts, their score usually improves. Higher scores make it easier to qualify for loans with lower interest rates. Lower scores can make borrowing more expensive or even impossible. In many ways, a credit score measures financial trust. Now let's step back and think about money itself. Paper bills and digital balances may feel powerful, but their value comes from something surprisingly simple: collective belief. Money works because people trust that others will accept it in exchange for goods and services. Governments issue currencies, central banks regulate supply, and businesses accept it as payment. As long as people believe the system works, money continues to function as a medium of exchange. But holding money alone is rarely enough to build long-term wealth. This brings us to investing. Investing is the process of using money to purchase assets that may grow in value or produce income over time. Some people invest in stocks, which represent small ownership shares in companies. Others purchase bonds, essentially lending money to governments or corporations in exchange for interest payments. Some invest in real estate, hoping property values rise or generate rental income. Investing always involves risk, but historically it has been one of the most effective ways to outpace inflation. Another concept tied closely to wealth is value. Objects themselves are not inherently valuable. Instead, value comes from how much people want something and how limited it is. A rare mineral may become valuable because it is scarce. A piece of technology becomes valuable because it solves problems for millions of people. Businesses that create products or services people truly need often generate enormous economic value. Finally, there is one resource more powerful than money: time. Everyone receives time, but no one receives unlimited amounts of it. Many jobs exchange time directly for income: work an hour, earn a wage. But the most effective financial strategies find ways to multiply the impact of time. Investments, businesses, and valuable skills allow effort today to produce benefits for years in the future. When money is invested consistently over long periods, compound growth gradually accelerates. At first, progress seems slow. Then, years later, the results become significant. That is the quiet secret behind many financial success stories. Not luck, not shortcuts, just time, discipline, and consistent growth working together.